least that's what we've said in the past. So I'm going to go ahead and start that recording. And what I want to do today, welcome back to class, is go over the midterm 2 results, see if there are any specific questions about any of the questions from midterm 2, and then jump into the chapter 8 lecture. As we have been doing, we'll go through the slides and we'll go through the practice midterm for chapter 8. Okay, and maybe we'll take a quick look at the syllabus too, so we kind of see what's ahead before we jump into the chapter. So with that, let me go ahead and close this little thing. And you can see pretty good results, consistent with what we saw on the first midterm. Okay, so we're averaging, you know, pretty close to a B plus. I mean, B plus heading towards an A. I think, you know, if you find yourself in that range and you do a good job on the guest speaker write-up, you should be in pretty good shape for this class. You know, you see yourself maybe down a little lower here. This, of course, is not the whole class. This is just for that one exam. But if that's sort of where your grade is with the class, then, you know, you want to definitely make sure you're doing a good job on the guest speaker and start thinking about and maybe reaching out to me about what you may not be doing in preparation for the exams. It's causing you to fall into these lower ranges. But most of us pretty good. I mean, someone even got 100% on the exam. So, okay. Any questions about any of the specific questions? Okay, I'll take that silence as a no, that we don't want to go through any particular questions. Going once, going twice. Okay, then let's go ahead and, if there's no questions on that, take a look at the syllabus. Okay, so probably a good point for us to kind of take a peek forward and see what we're looking at, see where we're going here. So I'm just going to do it from this mode. I think is good enough for our purposes right now. I don't have to wait for it to open. And there we are today, 414. And then next week, we'll take a look at chapter 9 is simply a way of explaining why we do what we do in chapter 10. So we'll take a look at a couple quick slides from chapter 9. That won't take our entire class time. We'll get into chapter 10, and then we will maybe finish that on the 21st. I don't know. We'll see. And then chapter 13 will be left, and then we'll be in full final exam prep mode. Final exam is not cumulative, not comprehensive, whatever term they use. So it will simply be chapters 8, 10, and 13. So it'll just be those 3 chapters. Chapter 9 is more like an introduction to chapter 10. So there'll be specific questions, though, from chapter 8, 10, 13. That'll be the final exam. Okay, and we'll continue the same format that we've been doing. I'll open the exam up at the beginning of the week, whatever it is for that week of May 23rd, and I'll leave it open for the full week. The key thing that you need to really start thinking about is, hey, you know, what do I got to do for this paper? So make sure that you're thinking through that. But I'll open the exam up for that entire week so that you have it for the full 7 days, and I'll give you more details to when it's going to open, when it's going to close, that kind of stuff. Okay. Question? Okay, good. If there's nothing about that, then I can let the syllabus go, and I can take us to chapter 8. We're not to the end yet. Okay. And let's just put it in slideshow. Okay, put it in tablet mode. Okay. Okay, good. So you can, right? Okay. You can hear me, but you can't see me, which maybe is a good thing. So let me go ahead and, I don't know. I thought I had started that, but maybe I closed it by accident. Okay. All right, good. So let's go ahead and let's start to take a look at chapter 8. And we're talking about budgeting here. Okay. Now, what I'm here to tell you is there is no way to be involved in any organization, be employed, be it a not for profit that you're volunteering for, that you're not going to run into budgeting questions, okay? In terms of how are we going to allocate the funds that we have available to accomplish the goals of the organization, okay, whatever it is. So it's good to have this exposure regardless of whether you're thinking accounting or you're thinking about marketing or you're going to be an entrepreneur and start your own business, right? At some point in time, you're going to have to deal with budgeting issues, okay? So it's worthwhile for us to understand, and what we're going to look at is really the building blocks of budgets and how those building blocks are used to put together. And we're going to talk in this chapter about an operating budget. Operating budget covers 1 year, okay? But we will talk in chapter 13 about something called a capital budget, which tends to look over multi years and looks more into the future beyond just the upcoming year. So it covers more than 1 year period. Okay. And we'll talk about that later. Okay. Now, when we talk about the process of preparing the budget, I guess that could be called budgeting, and we're trying to achieve something called budgetary control. Okay. So you sort of look at that it's used as a planning tool to look forward, and it's to hold individuals accountable. And I don't know that they have to have a whip there and a chair, but it is intended to hold individuals accountable to whatever goals the organization is trying to achieve. Okay, so we have something called responsibility accounting. And with responsibility accounting, all that means is you hold individuals responsible to things that they have direct control over. So that was sort of like when we talked about segment reporting, we weren't going to allocate cost to segments that they did not have particular control over, right? And so common costs were not allocated. Same kind of principle here, in that we're only going to hold individuals accountable to those costs that they can control. As I've stated, operating budget is what we're talking about here in chapter 8. It'll cover, of course, this is a little dated, but it'll cover the current year. Okay. Now, when we get into chapter 13, we'll talk about budgets that cut across multiple years. And we're going to see that we're going to have to use time value of money in some of those analysis. But that's chapter 13. For chapter 8, we're right here. We're talking about an operating budget that will cover a single year or 12 months period worth of time. Okay. Now, when we look at how budgets are put together, the notion is that the information for the budget, although it's ultimately approved by top management, should be getting information from all levels of the organization. And so these arrows that are sort of coming from off the page there would say that we would have staff involved in developing that budget, and then it's ultimately approved by senior management. Okay. So if we have self-imposed budgets, that means that we're asking members of the team to determine what the budget should be. We have the benefit that that information has the potential of being more accurate because we have those that are well acquainted with the details providing input into that budget. Okay. Motivation is generally higher if individuals know to what extent they have had input into the budget, and so they're going to want to live within those ideals, because or those not ideals, but those goalposts, for lack of a better word. Okay. And it avoids an unrealistic budget because we have those actually involved in the day to day contributing to that budget. Okay. So it should basically avoid this idea of budgetary slack, meaning, and you saw the arrows pointing up to management, ultimately management's going to look at that and say, okay, can we get a little bit more out of this budget than what the staff members are saying, because maybe they're trying to figure out how to make their lives a little easier. Okay. So, human factors, we want individuals to be enthusiastic and committed. We want to avoid pressure and blame. So, we want a highly achievable budget. And they show these people happily throwing boxes. Okay. Now, look, the reality is any budget that comes down is probably going to be whined about and griped about, because a budget in and of itself is trying to keep us sort of channeled towards achieving the organization's goals. They call that work. And as human beings, we tend to do what? We tend to whine about work that we have to do because we'd rather be sitting somewhere, enjoying life, right? Rather than doing this work. Okay. So, these processes will, probably make these, the not processes, but the things we've talked about, the sort of human factors that we've talked about here, will make things, maybe these boxes a little lighter, but don't by any stretch of the imagination ever think that people are just going to be so happy because they're having to live within a budget. Human beings tend to be, upset when they have to live within a certain constraint. Okay. All right. So enough with that fun stuff. What we're going to understand here in detail is the process of preparing our budget. Okay. And everything starts with the sales budget. Once we know what we need our sales to be, how do we know what our sales need to be? Maybe we did a break even analysis and we figured out what our budgeted sales are going to have to be in order to meet a certain target profit, whatever, right? Going back to chapter 5. Okay, so we set up that sales budget, and then based on that sales budget, we know how much we have to produce. We know what our production budget is. Once we know how much we have to produce, then we can figure out what is the cost of and there's our three factors of production: our materials, our labor, and our overhead, right? There we go again with stuff from chapter 2, 3, right? And of course, we will be able to budget whatever inventory we want to have available, because we're not just going to sell out our entire stock at the end of the year and have to start from zero at the end of the year going into the next year. So we'll probably have ending inventory, and we're going to have to budget for that as well. Okay. Now that's that's our product cost side of things. But of course, remember, we have our period costs, our selling and administrative expenses. So we got to figure out what those are as well. And we will use these to figure out, okay, what's our cash budget? How much cash are we going to have have available to make it through the budget period, the operating budget, the year? And we tend to do this a quarter at a time. Okay, but we would have to determine how much cash we need to operate each quarter. And then you put together the quarters, and that constitutes the entire year. Okay. And then based on all this, we can prepare budgeted financial statements, basically the budgeted balance sheet, budgeted income statement. And those documents then go throughout the entity, throughout the company, high levels, medium managerial levels, supervisory levels, and those budgeted financial statements are used to then track how we're doing against our budget. And when we get into chapter 9, 10 next time, we'll see how we will evaluate variances from our budget projections. Okay. All right. So that's just an overview. So let's just go ahead and take a look and start with the sales budget. That's the first thing. Okay. And so we're going to come up with our sales budget, and then we're going to see what our cash collections are going to be. Because remember, at the bottom of that, I'll just put it up there again. At the bottom, we're trying to drive a cash budget here, right? Okay. So we're going to go ahead and figure out what our sales are going to be and then what our expected cash collections are. Okay. So they give us this nice little example here that we have this entity that has budgeted sales for the next 5 months, April, May, June. July, August, they say that the selling price is $10 per unit. Okay, we maybe came up with that sales price because that sales price will help us meet some target profit or something, right? And we figured out how many units we need to sell to meet that target profit. And then we decided how we would take that out over the next several months here. Now, when we look at this, they're giving us information beyond the second quarter. But when we look at this, we're really going to be focusing on April, May, and June's sales budget. So we're going to be doing it for the second quarter of the year. You break the year into quarters. January, February, March is the first quarter, April, May, June, second quarter, and so on. Okay, so we're really focusing on the second quarter here more than anything. Okay. Now we will also pick up some information though, it's worthwhile noting for July, because we want to know how much we're going to have available in ending inventory at the end of June, and that will factor into what we have to actually produce in June, because you never want to finish a month with nothing, right? You want to always have something left on the shelf. So even though you're budgeting for the second quarter, April, May, June, you would probably look to see what you need at the end of June to help feed your production requirements for July. You never want to start a month with nothing on the shelf. That would be a poor operational decision if you did something like that. Okay. Now, when we figure out what our sales are going to be in dollars, it's very simple. We take the what? We take the units, April, May, June, 20, 50, 30,000 units, each one of those months. We multiply that by $10. God made Excel for this kind of analysis. Okay, so they're sort of showing you an Excel example. I guess Excel thought it would be okay, or Excel said it would be okay if the textbook provider used their icon there. Okay. But you would do this kind of an analysis, probably using a spreadsheet function like Excel. And you can see our total budgeted sales, the number of units times the dollars. That's telling us what our sales are going to be, obviously, in dollars. Okay. Now you come over and we look at our collection pattern. Okay. So what does that mean? Well, we're probably going to offer credit sales, right? We don't expect people to just walk up all the time with the cash. So we tell you that, yeah, 70% of the month sales will be collected in that month, but 25% will be collected in the following month, and then 5% will be uncollectible. Okay. Now they tell us that we start out what? April with $30,000 in a receivable status, and we're going to collect that in April. So at March 31st, they had accounts receivable, and that then got collected in April. So that's going to be cash that's going to come in April. So we take a look, and they just give us that number that, hey, you got 30,000 coming in April. Don't you say, where did they get that number? They made it up. Okay, I'm not going to sit here and say where they got that, because I don't know. They just said they had 30,000 that was outstanding at March 31st, and they collected that sometime in April. Okay, now we can use the information we have, since our April sales were supposed to be 200,000, but we're only going to collect 70% in the month of sale. We take that 200,000 times 0.7, we'll get 140,000 of the April sales in April, 50,000, 25, the remaining 25% that we're going to collect will come in May. Okay. Now, let me ask you a question. What happened to that 5%? Why isn't that up here?
Because it's uncollectible?
Huh?
I was gonna say because it's uncollectible.
Yeah, exactly. Right. I just want to make sure because sometimes that's very good. Right. Sometimes, you look at a question, you say, well, where's the 5%? You basically ignore that, right? I mean, if they tell you it's not collectible, then you say, hey, I'm going to collect it, right? So they're really only going to get 95%, right? Of which 70% will come in April and 25% will come in May, right? Okay, good. Now, they had the 30,000 that was outstanding at the end of March. And so if you take the 30,000 plus the 140, what'll be collected in April is 170,000. Good. Okay. Then what? Then you come to the 50,000 that they're going to get in May, and then they're going to have sales of 500,000. You say, where'd that 500,000 come from, John? Again, that's coming from that first Excel spreadsheet here, right? 500,000, right? For May. Okay. I'll get 500,000 of sales in May. 75% of that will be collected in May, or excuse me, 70% of that will be collected in May, or 350,000. The remaining 25% will come in June. And so on. We do June and we get 70% of that in June. I guess June is spelled Gun these days. Okay, I guess they didn't want to put the E in there, whatever. The June sales, and then we have the 70% of that collected in June. You say, well, where's the 25%? Well, hey, we'll deal with that when we put together what? The third quarter's budget, July, August, September, right? For this, the second quarter, which is April, May, and June, we don't worry about, amounts that are going to go into that third quarter. Question? Okay, good. Now you come over and you take a look at the production budget, because we know we want to sell those units that you saw on this slide. So we move to the production budget. So what do we have to spend to produce these many units to drive those sales and then ultimately drive those collections that we just did? Okay, so we move to the production budget, and we have 4,000 units on hand at March 31st. Okay, so we're going to always start a quarter / a month with units already on hand. And then we're going to make sure that we always have ending inventory equal to 20% of the following month's budgeted sales. Again, we're just trying to avoid having our shelves empty at the end of the month / quarter. Okay, so you come over and we want to have budgeted sales of 20,000. Okay, desired ending inventory is what is I think I have to click it again to make them show that calculation. No. Okay, well, I'll show you right here since they could have shown you. Oh, there it is. Hello, it's right there. It's right in front of me. So since the next month's sales were what? Were 50,000, and I want a desired ending inventory of 20%, then I want to end the month with 10,000. So you will do this like this. When I show you questions, you set them up like this. What do you plan to sell in the month? What do you need left over at the end of the month? That gives me total needs of 30. But the problem told me, they just gave me this, the information, the example just gave me this, tells me that they had 4,000 on hand already at the beginning of the month, at the end of March, beginning of April. So they need to only produce 26,000. Okay, we do the same thing for May. We look at that next month, 20% of the 30,000, 0.2 times the 30,000 gives me what? 6,000 that I want to have available. My sales are going to be 50, so I'm going to need 50 plus the 6 that's supposed to be left over. That'll give me 56,000, but I'm going to start what? I'm going to start May with what I had left over from April, so I can subtract that off. So I'm going to have to produce 46,000 in May. I go ahead and I do the same thing for June now. Okay, so I come over and it's not showing on the screen here, guys, but trust me, they went and they looked at the July sales units, which was what, 25,000. And they went ahead and said, okay, I want to end up with 20% of that. That's where they got the 5,000. So they need 35,000 less what? Less the beginning inventory, which was 6, which was May's ending, is June's beginning. So I need to produce 29,000. Any question on that? Okay. Okay, good. So I know how many units I have to produce. And so now that I know the units that I'm going to have to produce, I'm going to be able to go in and figure out, well, what's the materials I need to produce this. Once I know the materials I need to produce this, I'll turn my materials into a dollar amount so that I'll know how much I have to spend. What are the dollars I have to spend on materials? What are the dollars I have to spend on labor? What are the dollars I have to spend on overhead? The three things that we trace directly, that we don't trace directly, that are our product costs. Obviously, overhead is indirect. The things that go directly into my product costs, don't use the word directly, John, because some of them are indirect. The costs that constitute, there you go, my product costs, my direct material, my direct labors, my direct labor, and my overhead. Okay. All right. So let's just go ahead and take a look at that. And so we start with the materials budget. And they say, hey, for each one of those units you said you have to produce based on your production budget, you need 5 pounds of material. And just like you wanted to be left over with some inventory at the end of each month, you want to be left over with some materials at the end of each month. So you want 10% of those materials to be left over at the end of each month. And the materials, because we need to turn pounds into dollars, cost you 40 cents per pound. So now we can go ahead and we can do the materials budget. So there's the units that came from the production budget that we just worked on. We know we need 5 pounds um, per unit. So there's the pounds we need. Our desired ending inventory is going to be what? Is going to be 10% of what we'll need to meet the next month's budget. So since next month we need 230 pounds, we'll need what? 23,000 left over to make sure we have 10% left over. There's our total needs. We have our beginning inventory, which was March 31st inventory of materials. So we would subtract that because we already had those on hand, right? So we have the 140,000. We do the same thing for May. Okay, we sit there and we say, well, we have 230,000. Our desired ending inventory is going to be 10% of what we need for June. 145,000 times 10% is 14,500. So we need a total of 244,500, but because we made sure we had something left over at the end of April going into May, we can subtract that off. So total materials needs to be 221,500. We do the same thing for June. I don't know why they say assumed ending inventory, makes it sound like they pulled the number out of the sky. All they did was they applied the same logic, 10% of now July's, and that's how they got this 11.5 here. And so we would need enough to meet July's production, materials to meet July's production. So that gets me this 11,005 plus the 145. But of course, we subtract the beginning inventory, which is the previous month's ending inventory, and that gives us the materials purchased for June. Any question?
Just to make sure I have it. So we got the June desired ending inventory by um by multiplying point like 10% from July's what do you call that? The production needs.
Correct. Yes.
Okay, making sure.
You when you say desired, you mean desired ending inventory, right?
Yeah.
Yeah. that 11.5 is that same process, in that um, we had established that we had, if you look down, we needed 25,000, right? But then
Mhm.
we needed amounts to cover the previous, the amounts to cover the next month, I should say, which had you going and looking at what you would need to has for August at that point. So then you would subtract off. We had 5,000 in beginning inventory, so we would have 23,000 would be our needs, and then we would multiply that by the 5 pounds. That gives us the 115 times 0.1 is 11,500. So it's not as easy to see, and they threw that assumed. I wish I should figure out a way to get rid of that, because it sounds like they pulled it out of the sky. But they went through that same process of looking, as you said very well. You look at the production budget, figure out what you need to produce, and then multiply that by the 5 pounds. But we never saw that calculation, is why it might be a little confusing.
Yeah, I think that's where I got confused just because I didn't see it. But I
Yeah,
understand.
we didn't have it on, on when we were coming up with the total materials to be purchased. We didn't show it in anything. We didn't show July in the production budget at all, where we got those numbers. Well, I guess we could see where we got June's. Where was it? For the 29,000 for June, I think they showed me how to get that. And so then you would go from there. Well, what's the desired ending inventory, et cetera. And that's how you got to what you needed for June materials. Okay. They just didn't show you the calculation. Okay. So you come over and is going to turn those pounds into dollars. So all you do is you take those pounds, okay, and you multiply them by, where did that go? Where did they turn the pounds into dollars? Something's missing. Okay. So, oh, here, it's right here. Okay. Sorry, guys. Sometimes these slides get a little weird. Okay. So we know then that what they're going to, let me go back. Sorry. Okay. It's 40 cents per pound. Okay. And 1/2 of the month's purchases is paid for in the month of purchase. The other half is paid in the following month. And we had 12,000 of accounts payable at the end of March. So we'll start April with 12,000 of accounts payable, of which we are going to pay that. They just tell us we're going to pay that in April. Okay, so that deals with that 12,000. Then what? Then we go ahead and we say, well, if we need 140,000 pounds, you see it up there, of material, 140,000 pounds times what? Turn our pounds into dollars times 40 cents. That means that's a total of 56,000, of which what? Half is paid in April, half is paid in May. Okay. All right, good. Now we go forward and we pick up the what? The 21,500. We multiply that by 0.4, and that gives us what? 88.6, of which half will be paid in May, half will be paid in June. Then we go ahead and we go to June's purchases, and we take the 142 times the 40%. That gives us 56,800. We'll pay half of that in June, half in July, but again, we're not preparing July's budget. Okay. And then when you get the quarterly numbers, guys, you simply what? You simply across, right? Now, of course, you don't have to add anything. You just pull the April number over, but you simply add across and then add down, and that gives us the quarterly number of 185,000. Okay. Question? Okay, good. We've got our materials. Let's go ahead and do our labor. Okay. So we say, well, look, it takes 3 minutes, 0.05 of direct labor to produce one of these units. But we have a no layoff policy. So we're going to guarantee that we'll pay our employees 40 hours of work each week. We pay them, come on, we got to update this. I mean, let's at least get them up to a decent minimum wage. We got to pay them $10 per hour. Of course, we'd want to pay them more than that. And then we guarantee a minimum of 1,500 hours. Okay. So if we need more than 1,500 hours to meet our production, we'll use that bigger number. If we need less than 1,500 hours to meet our production budget, we'll use 1,500. Okay, because we're going to guarantee that we're going to pay 1,500 hours. So you take a look and you can see the units now. Now we're going to turn those into the number of labor hours. It's 0.5 per unit, 0.05 per unit. Then we go ahead and we multiply it by the greater of what we actually need for the production, or the 1,500. So notice April and May were a little April and June were a little under the total number of hours we need to meet that production, but we guarantee our employees 1,500 hours. So we're going to use the 1,500. In the month May, when we have a higher production, we need more hours. So then we use that 2,300. So it's the greater of what? The minimum or the actual needed to meet production. You take the bigger number. Question on that? Okay, so we've got hours. Now we just multiply it by the dollars. This horrible salary of $10 per hour. And what's minimum wage? It's minimum wage more than 10, isn't it?
It's like
They're trying to,
1550.
huh?
1550.
State of California, maybe. They're trying to pass a federal minimum wage. So I don't expect you to know every state. I don't know. I think the federal minimum wage is like down around what, $7 or $8 or something. Okay, so they're trying to pass. Uh, they'll pass it with maybe 51 votes, but they keep having the trouble that Joe Manchin, the senator from West Virginia, doesn't seem to want to vote for anything that his own party wants. So I don't know that they'll get $15 minimum wage through. They tried to attach it to the COVID relief um, bill that they just passed, but the Senate parliamentarian, I'm not saying that right, parliamentarians said that they couldn't do that as part of the budget, so they had to drop it. And so they're going to have to try to pass a separate bill. I don't know how they're going to get that through. So yeah, it's 15 something, you say, in California, but some states it's like down in the single digits. Okay. Anyway, completely irrelevant discussion to what we're looking at here. Once you multiply out the hourly wage, then you get the labor costs. Okay, good. Any question on that? Okay, good. Let's go ahead then and let's take a look at overhead. Now, what's interesting about overhead, guys, remember we have what? We have our indirect materials, indirect labor, and then we had the others, right? And the others were things like what? Our rent on our factory building, these kinds of things, right? All right, now let me ask you this. Do all indirect costs use cash? Let me say it another way. Can you think of an indirect cost that doesn't use cash? What are the others? Give me examples of others. I just gave you some. Okay, give me examples of indirect costs. Give me examples of overhead costs. I'm more than happy to give you a comprehensive final. If you're going to tell me that, John, I'm not going to remember anything from this class, no matter how basic the thing is, no matter how elementary the thing is to what we're supposed to learn from this class, then I have to think, I have to give you a comprehensive final, right? Because you're not going to remember anything.
Rent will be an overhead cost.
Huh?
Rent, utilities,
Okay,
sales and
rent,
marketing.
good. Utilities, these are all fitting under others. Good. What else?
Maybe administrative costs.
Administrative costs are not overhead. I mean, they are overhead, but they're not production overhead. We're talking about production. So they're overhead, but they're not production overhead. We don't put it as a product.
Equipment.
We treat it as an expense cost. What about equipment?
What about it?
What journal
Depreciation.
did you make when you? Huh? So what?
Depreciation.
Okay, good. Depreciation, right, is a overhead item. And what journal entry do you make when you have depreciation expense for the period? Say I bought a piece of equipment for 100,000 and I determine it has a 10-year life. How much depreciation should I take per year? So let me get this straight. You're going to come out of San Jose State with a business degree and you're not going to be able to answer this question?
I would say I was gonna say 10,000.
Okay, good. So that's going to be $10,000 per year of depreciation expense, right?
Yeah.
Okay, good. What's the journal entry for depreciation expense each year? The journal entry for depreciation expense each year. I'll give you a hint. There's going to be a debit and a credit of 10,000.
Would one go to depreciation expense? The other goes to accumulated depreciation.
Okay, and I'll give you credit for the order that you said them in, that you knew which one was the credit and which one was the debit. Good. So I'm going to sit there and I'm going to debit depreciation expense, credit accumulated depreciation. Now, if I'm dealing with a manufacturing entity, I'm still going to credit accumulated depreciation, but am I going to debit depreciation expense? That debit in a manufacturing entity is going to go to what? Manufacturing overhead, 10,000. And when I have my manufacturing overhead, I'm going to sit here and I'm going to have to put that debit of 10,000 on the actual side. What goes on the credit side? That's that debit. What's credited over here? How about whoever got 100 on the last test? I mean, how do you get 100 on an exam and then you can't answer a basic question like this? I don't think I ever got 100 on any test I ever took. in accounting. And I ended up being a CPA. Okay, we have on this side applied. Should we just be posting these recordings up each month? And I mean, I have recordings of these lectures. I can just put the recording up and then you guys can just watch the recording. I mean, I'm assuming there's a desire to have some sort of dialogue here, right?
Yeah,
Okay,
I just don't remember, to be honest.
okay. Well, you've been doing a good job of helping us along here. So it's not like you're the only person that is expected to carry the whole ball for everybody here. But I expect somebody out of my 30 students that are sitting here to understand something about this class. So the manufacturing overhead applied is going to be going where? If there's the credit, where's the debit going? There's a credit based on the predetermined overhead rate. Where's the debit going?
Like which side of the T-chart?
Well, that's an introductory business 20 question. I know that debits are on the left. I want to
It goes to work in process, the job cost sheet.
Well, you should have stopped at work in process. I don't know about the job cost sheet, but good. The debit goes to work in process. Very good. Debit goes to work in process over here. And that's how we're going to track our overhead costs through our accounting system, right? Okay, just going back to that. Okay. All right, good. Just want to make sure that you're engaged and kind of thinking through this stuff. Okay, good. Now, what happens? Did we use any cash when we accounted for our depreciation? Why is that question hard? Did we use any cash when we accounted
No.
for depreciation? Huh?
No, we
No, I mean, everybody should have unmuted and say, I'm finally going to say something here because John just asked the easiest question in the world. Obviously, no cash is involved because I'm sitting here and I'm doing what? I'm debiting manufacturing overhead and credit accumulated depreciation. So there's no cash that's associated with depreciation. Okay. So when we look at our manufacturing overhead budget, we're going to have to what? Tease out the non-cash overhead items because remember, we're preparing a cash budget. Okay, that's all I was going with that. And I thought that would take 2 seconds to talk through, and it ended up being a revealing of things that we maybe should go back and take a look at to see that we get some things out of Business 21. Okay. All right, good. So you come over and they tell me that we have our variable manufacturing overhead rate, which is using as our driver our direct labor hours, $20 per direct labor hour. We have our fixed manufacturing overhead, but they tell us it includes what? 20,000 of non-cash costs, which is primarily depreciation. That's why I was going through that. So you'd understand, oh, okay, that's why they're calling out depreciation as a non-cash cost. Okay. All right, good. Now you come over and you take a look and we pick up the direct labor hours that we had gotten from our labor budget. We multiply that by $20 per hour. That's our overhead rate. That gives us 26,000 in April and so on, May and June. Then we bring in the fixed, which they told us was 50,000 per month here. And then we have what? We have our total manufacturing cost, and this is including the variable and the fixed. Now, at this point in time, they do this and they stop with this little calculation here of our predetermined overhead rate. We want to know our predetermined overhead rate because remember, we're going to apply our overhead to our jobs using that predetermined overhead rate. That's going to go through work in process, from work in process to my finished goods inventory, from my finished goods inventory to my cost of goods sold. So I do need to figure out my predetermined overhead rate here, which I do. Okay. And then and basically there's taking it for the whole month, 251 divided by the 50/50 for the month, for the quarter, the entire quarter for the quarter. Once I do that, I can put that number off the side. So it's going to help me to prepare my budgeted balance sheet and my budgeted income statement here in a little while. But I can go ahead now and back out the non-cash portion of my fixed overhead, which is mostly depreciation. And then that gives me my actual cash disbursements for my overhead. Because remember, I'm preparing that cash budget. But I stopped to get that overhead rate because I'm going to need it when I finally get down there and I'm able to prepare my budgeted balance sheet and income statement. Okay. Okay, good. Any question on that? Okay, so that's what we're doing on the next slide. We're saying, well, look, what is going to be the cost of our finished goods inventory? Because we're going to have to produce a finished goods inventory because we don't want to start the quarter with nothing, no inventory available. We don't want somebody walking in on July 1st saying, hey, yeah, I'd like to buy. And we're like, sorry, it's the beginning of the month and we're all out of stuff. Okay, so we want to have some things left on hand. So we know that we need what? 5 pounds of direct material per unit. We know that we are going to need 0.05 hours per unit. We pay $10 per hour. That's that horrible minimum wage. We pay the what? 40 cents per unit for the materials. Okay. And then for our manufacturing overhead, we know it's tied to the direct labor hours per unit. And we just figured out a minute ago that our direct labor, excuse me, my predetermined manufacturing overhead per direct labor hour is $49.70. So I use the direct labor that I would need for one unit, 0.05. And I now have my cost of my inventory per unit of $4.99. I go ahead and this is a what? This is not a cash number now. This is an accrual number, right? Okay, we've got our cash numbers for our cash budget, but we now have our accrual number for our inventory. We multiply that then by the number of units that we plan to have in ending inventory, going all the way back to our production budget. We plan to have 5,000 units in ending inventory at the end of June, times $4.99 means that our finished goods inventory will be 24,950. We take that number, we put it over to the side, and when we're ready to prepare our budgeted balance sheet, we will report a finished goods inventory of what? 24,950. Okay. All right, good. So now let's figure out how much cash we need for our selling and administrative expenses. We got our product cost now. So remember that first chart I put up, we said, hey, we got to have materials, we got to have labor, we got to have manufacturing overhead, got those done. We got the cash budget associated with those. Now we're over here on the side getting our period cost or selling and administrative, and we're going to figure out how much cost are we going to spend on those. So we come over and they tell us that, hey, it's 50 cents per unit sold is the variable. The fixed is 70,000, but then we've got some non-cash costs of our of selling and administrative cost. 10,000 of the total 70,000 fixed are non-cash. They're primarily depreciation. So now it's the depreciation on what? My office building, right? Okay. So, and I won't go back through the depreciation discussion. So what happens, I'm just going to go ahead and put the whole quarter up. I don't see any reason to build it by quarter. We take the 20,000 budgeted sales, 50 cents per unit sold. That's 10,000. 70,000 is the fix. Now notice we have the total here. This total is going to be used when we actually prepare our budgeted financial statement, our budgeted income statement. Because remember, period costs are what? Period costs um, are reported on the income statement. They're period costs, and I need to pick up the accrual number, not the pure cash number. So I will use that number when I prepare my budgeted income statement, right? But to calculate my cash budget, I go ahead and I back out those non-cash expenses, mainly depreciation, and that gives me now the cash that I need for my uh, selling and administrative costs. So let's think about it now. I've got the information I need on how much cash I'm going to collect each month. I've got the information on how much cash I'm going to spend each month, right? Our materials, our labor, our overhead, we did the cash for those. We're doing the cash now for our selling and administrative. So do you think I'll know how much cash I need each month here? Yeah, I'm going to know how much cash I'm going to need each month here. So let's go ahead and figure out. Maybe we're going to have a cash shortage. Maybe we'll have some cash left over. Let's take a look. Okay. And, for the people that aren't saying anything, that are like, um, watching TV or something, or listening to music, or staring off into space while I'm doing this, um, remind me not to invest any money with your company when you start it. Okay. Because this is what potential investors expect you to be able to do. They expect you to be able to say, you want to borrow some money from me? Well, show me why you need to borrow that money. Show me why I should invest in your company. I want to see how you're going to spend that money. So if you think this is just sort of some silly accounting thing that you have to take, this drives business development, all of this stuff. Okay. All right. So we go ahead and we can now prepare our cash budget. Okay. So we know our cash receipts. That's from our sales budget. We know our cash disbursements. I mean, everything flows from the sales budget, but we have the cash disbursements for materials, for labor, for overhead, for our selling and administrative. And we're going to see if we need to borrow money, or we're going to see if maybe we have some money left over that we can invest in a short-term security of some sort until we actually need that cash for our operations. So we go ahead and we start doing, we need some information here, which is we have a line of credit. It's a 16% interest rate, which would be astronomical in today's environment, but whatever. We maintain a minimum cash balance of 30,000 at the end of each month. Okay. We're going to pay a cash dividend in April. We're going to purchase some equipment in May and in June. And we're going to start the first month of this quarter of April with 40,000. Okay. So let's go ahead and let's take a look now. So we start with 40,000 from our cash collection budget for April. Okay. I'm not going to click back to prove it to you. We said that we were going to collect 170,000. So we'll have 210,000 cash available from our cash disbursements journal, for our materials, our labor, our selling and administrative expenses. That's why we sat there and figured out that cash part of those, right? We are going to spend this amount of cash, 15, 56, 70, whatever. Then they're going to pay a dividend of 49,000. So the total disbursement need is what? Is 230. And when we take a look, we're going to end up $20,000 short. We want to end up with what? With a $30,000 cash balance at the end of each quarter. So we're going to have to borrow 50,000. Now, let me ask you a question. How good of a business decision do you think it is to pay a dividend of 49,000 and then turn around and essentially have to borrow that money to pay the dividend. Is that very smart?
No.
That's ridiculous. If I was thinking about sitting here and investing in this company, I'd say, what the hell are you doing? You're going to pay me a dividend so that you can then go borrow money and charge interest against my ownership of this company? That doesn't make any sense. Okay. So maybe the preparers of this example wanted us to have that interesting conversation, but this would be a very poor business decision that I don't think anybody would make. Go borrow money to pay dividends. Okay. But anyway, they were short. They wanted 30,000, so they had to borrow 50. Okay. Now, when we go to May, okay, what happens? The disbursements budget, the collection budget, we would have pulled the numbers from there. That means that we're going to end up with what? 30,000 left over. That's what we wanted. So we don't have to borrow. We don't have anything left over that we can invest. You get to June, our disbursements, our collections, we're going to end up with 95,000 left over. And now we can go repay that money that we borrowed, the 50,000. And this was my point. But now we incurred interest because they told us it was 16%. And we borrowed the money, I guess, April 1st. So all of April, yeah, it says right there, April 1st, all of April, all of May, all of June. That's 3/12 of the year. So to pay a dividend of 49,000, it cost us what? It cost us 51,000 to pay that dividend. How silly of a decision would that be to spend $51,000 to pay a dividend of 49? That would be ridiculous. Okay, so again, that wouldn't be a very good business decision anyway. So they, whatever, the point is to understand the mechanics of this thing, which is they pay that interest. And so they're going to end up with 43,000 left over at the end of the quarter, at the end of June. Okay. Okay, good. Now you come over and now we can go ahead and prepare our budgeted financial reports. We'll start with the income statement. Okay. Now, when we look at the income statement, we're back on accrual accounting. This is not cash now. Okay. Because remember, there were some amounts of cash that still hadn't been collected for our sales in the second quarter. We're not going to collect some of those until July. Well, for our budgeted income statement, we just say, hey, we're selling 100,000 units in this quarter. And if you went back to the production budget and added up the units for sales for April, May, June, they totaled 100,000, $10 per unit. Okay. Our cost of goods sold, you sell 100,000 units. And remember, we calculated our cost per unit of inventory was $499. So we'd have cost of goods sold of 499,000. There's our gross margin, selling and administrative expenses. And just to show you the difference for this one item, because I don't want to be clicking back to all of those schedules, but just doing it for selling and administrative because it's a little bit closer. Just remember that number in our slide deck. Just remember that number, 260,000. Okay. That 260,000 was what? It was the accrual number. It was not the cash number because the income statement is being prepared on an accrual basis. So that includes not only my cash expenses, but my non-cash expenses, because now I'm budgeting an actual financial report, and our financial reports use what? Use full accrual accounting, not just cash. I wanted to do my cash budget because I need to figure out how much cash I'm going to have at the end of the quarter to prepare my budgeted balance sheet. And I also need to anticipate my borrowings and whatnot. Look, you don't want to walk in the day you need that 50,000, whatever it was they had to borrow, and say, can I borrow? You want to be able to plan that out accordingly, right? So that's why you'd want to know what your cash needs are going to be. The interest expense was 2,000. So I show that as a non-operating expense. And so my net income is 239. That's budgeted, right? Okay. Then what? Then I come over and I can prepare my budgeted balance sheet, and they give me some information about some other balance sheet items that the company would know: how much land they have, what their common stock is, what their equipment is, etc. Okay. And so they go ahead and they pick up the cash from the cash budget. Accounts receivable still was outstanding at the end of June. Okay. Then we have whatever was still available in raw materials. Remember that 11.5 times the 40 cents, the 5,000 units of finished good inventory. We calculated 24,950. They just told us the land, the equipment. Then we set up the accounts payable for what was left of the June purchases. Remember, we'll pay 50% of June purchases in July. Our common stock, they just told us. Retained earnings, we will do what? We'll say what was the beginning balance was 146,150. They told me that they just gave me that on a couple slides ago. Add the net income from the budgeted income statement, deduct the dividends that I was all hopped up and upset about, that they paid a dividend when they had a cash shortage. And we end up with an ending balance and retained earnings and the balance sheet balances. Okay. Question. Okay. Now, we're going to get ready to look at the practice midterm after we take a little break here. And when we look at the practice midterm for chapter 8, here's what you're going to see. I am going to only ask you questions as they relate to each piece of the cash budget. So as it relates to the what? The number of units, the number of units we're going to produce, how much raw material will we need? If we know how much raw material we're going to need, then what is going to be our, let me back up. Starting with sales, how many units are we going to sell? Okay, we're going to sell these many units. What's the price per unit? Okay, when are we going to collect that cash? There's our cash collection. Then we'll get into disbursements, and I'll ask you about the disbursements, and I'll say, okay, how much is the disbursements for material? How much is the disbursement for labor? How much is the cash disbursement for overhead? How much is the cash disbursement for selling and administrative? So there'll be separate questions that will deal with each one of those elements of the cash budget. Then I may say, well, look, if the total disbursements are this and the total receipts are that, you have to borrow money or you have some money left over. Okay, that's as far as I'm going to go. I'm not going to make you put together the full budgeted financial statements, because by then, yeah, you probably would be turning that part of this over to your accountant to say, okay, here's my cash budget information, which you should know how that comes together, because you're an entrepreneur and you are sitting here and knowing what the operating needs are of your company. But when it comes to actually pulling together the budgeted financial statements, I could see you bringing in an accountant to do that part. And so I'm not going to expect you to pull that part together, but I will expect you to be able to determine the elements of the cash budget and how that's going to determine your cash needs for the period. Okay. All right. So we'll look at all that when we come back from the break, and be ready to help me out with some of those questions. And I'm not asking for your help because I can't do them on my own, but I expect you to participate and help me out with some of those. Okay. All right, guys, I will see you in what, let's do, yeah, we'll do 10 minutes. We'll come back at 7:25. Okay, guys, let's go ahead. I don't think I had paused the recording. Let me double check. Yeah, I had never paused it. Okay. You might have to fast forward past that break if you're going to look at this later. But let's go ahead and let's take a look at the practice midterm for chapter 8 now. And as I've said just before we left for the break, we're going to see how we're going to work our way through cash collections, production, cash collections, materials, cash budget, labor, overhead, selling and administrative, and then how we're going to figure out the amount of cash that we need. Now I'm going to go through one round of these. If there's some enthusiasm and we seem to be having fun as we're doing these, we'll go ahead and continue on. Otherwise, I'll let you look at the rest of them on your own. Okay, but let's just go ahead and let's take a look at these. And we've got what? We've got our RWT Corporation made collections on sales according to the following schedule. 25% comes in the month of sale, 65% in the month following the sale, and 5% in the second month following the sale. Now, when you look at these questions, guys, they really, you get kind of stunned and you're thinking, wow, this is some hard accounting stuff. Meanwhile, when you look at these questions, the reality is they're more about reading comprehension than they are accounting, okay? So you just sort of have to read them through and get a visual of what's going on with these to answer them. So they tell us that what? They tell us that, let's start with the 65%. They tell us that 65%, well, let's start with the 25%. 25% is collected in the month of sale, okay? So if they had what? If they're asking us for June, and they had June sales of 110,000, then in June, we would collect 25% of June, or 27,500. Then they tell us that what? 65% is collected in the month following the sale. So the month that follows May is June, so they'll collect 65% of May's in June. And then they say that 5% is collected in the second month following the sale. So what happens? Well, we would have had April, so we would have had what? May, June is the second month following April. So we would take the April sales and multiply that times the 5%, add those together. In June, they expect to collect 980,500. I mean, 98,500. Question? Okay, good. Let's take a look at this next one. Okay, that's the answer to that one. I just did it in a different order. Okay, and let's take a look at this one. Now, this one is, hey, what's the number of units, right? Okay, so they tell us here that Paradise Corporation budgets an annual basis for its fiscal year. The following beginning and ending levels in units are planned for next year. And then we come down, 3 pounds of materials are needed to produce each unit. If Paradise Corporation plans to sell 480 units, what would be the number of units it would have to manufacture during the year? Now, even though they gave me the 3 pounds, I don't need that here because they're just asking me units. If they ask me the pounds, maybe in the next question that came after this one, let's say, then I would have to take whatever the number of units are and multiply that by 3. But that was not relevant to this question, okay? The other thing that's not relevant then is the raw materials, okay? Because I don't have to consider the number of materials that are needed. They just want to know the units. Okay, so what happens? I need 480. This is the way you do these, guys. I know I need 480,000 units if I want to sell 480,000 units. Then they tell me they want to end up with what? 50,000 units. So I go ahead and add the 50. I have total needs of 530. But they tell me that I started with what? 80,000 units at the beginning. So I subtract that out. I need to produce 450,000 units. You know, I gave you a clean version, a not marked up version of this test, and you can kind of see the way the book did it. I don't want to get into the book's way. This is the way I do them. Try them this way. If you want to try to get to these answers another way, that's up to you. I'm just giving you some ways that I would answer these questions. Question? Okay, good. Let's go ahead and let's take a look at the next one. Okay, this one is asking me the number of what is going to be my cost of goods sold, okay, in sales dollars, and they tell me the expected sales. Well, sales are 100%. They tell me that the cost of sales is 60%. Now, when you look at the solution, which I would not do it that way, they take every number and multiply it by 60%, take the sales numbers, multiply it by 60% to turn in the cost of goods sold. That is a great opportunity to mess yourself up if you do that. I like to do everything on the whole number and then multiply my answer that I get using the whole number by 60%, since my cost of goods sold is 60% of my sales. Okay, so you take a look here at 60% of my sales dollars. So they tell me that they want to know, let's see, I'm going to try to erase some of this. It's making this a little sloppy. What is the dollar amount of inventory that they plan to purchase in August? Okay, so I know that I have to have enough materials to cover $480,000 of sales. So I start with that. Then I want to have what? They tell me in the question, they want 20% of the following month's expected cost of goods sold. Again, I do everything based on the total sales number, and then I'm just going to multiply the final number by 60%. So if they want what? If they want to end up with 20% of the next month's sales available at the end of August, 20% of 620, they're going to have to produce an additional 124,000 units. So total needs now is what? Is 704, but they would have started, and a mistake that students make a lot of times is they want to pick up 20% of July. No, you started August with what? 20% of August, of what you need for August. So you pick up that 580 times the 20%, you would have started August with 116,000. So on a sales basis, you'll need what? You'll need enough stuff to sell 588,000 units. And since my cost is what? Is 60% of my sales, I just multiply that final number by 60%. And that's how I come up with the right answer here, 352,800. Question? Okay. Okay, good. Let's take a look at the next one. Who wants to walk us through this one?
Would this be like the one we, not the one, let me,
Say again, I'm sorry, it cut off.
sorry, this would be like the one we just did?
Well, yes, with the exception of you don't have to do that funky 60% thing, because it's just asking me units. So there's no, excuse me, not units, but pounds. But it's kind of like a units question, because they tell us that it's 1 pound of material for each unit. So, you know, 1 pound times the number of units equals the number of units, right? So, so you don't have to really do any conversion to dollars. You don't have to do any conversion from pounds to units, because it's 1 pound of material. So having said all that, you want to try it?
Sure. So do we first multiply I'm just, putting pieces together from what you've written too.
Yeah,
We just multiply the 20% um, with the 18,000 of units.
okay, stop. Don't look at that calculation and try to fake it. Okay, so
I'm
how
just guessing.
how many, no, and I appreciate what you're doing. How many units are we going to sell? They're asking us for February, right? So how
Mhm.
many units are we going to sell in February? I mean, how many units are we planning to produce, excuse me, in February?
19,000?
Okay, so if we're planning to produce 19,000 units in February, then I guess we better have 19,000 units, right? So
Yeah,
you
minus
start with,
minus the extra 0.
correct. Okay, good. Okay, attention to detail is important, right? Someone could have ripped me off. I asked them for 19,000, they hand me 1,900 and I'm satisfied. Okay, all right, good. It's 19,000 units. Okay, good. Now, we want to have some units left over. We don't want to just produce 19,000 and then what? We're out of units, right?
Mhm.
Okay. So we want to end up with some, and they tell us that we want what? 20% of the materials that will be needed for the next month.
Mhm.
So what's the month after February?
March.
March, good. Easiest question I'm going to ask you all night.
Yeah.
Okay, good. So the month after February is March. So I pick up the 18,000 units for March. I multiplied that by 20%. So I want to end up with 3,600, right?
Mhm.
Okay, good. So then I have total needs. I'm just going to write that in. Of 22, it says total needs of 22,600, but I would have started March with what? 20% of what I need for March, right?
Okay, yeah.
Okay, so I pick up the 19,000, good, times 0.2. And so that's how we get the answer. And even though they called it out in pounds, we could use the units in our answer because, it was 1 pound per unit, right? Okay, if it was 2 pounds per unit, I would have done this the same exact way and then multiplied the final answer by 2.
Mm. Okay.
Okay, all right, good work. Let's look at, there's our materials. Remember, as I said, we're going to break these down by what? By materials, by labor, and then we'll do overhead, and then we'll figure out our cash needs once we figure out the receipts and disbursements, right? Okay, good. So we've figured out receipts. We figured out our materials that we need. Let's take a look at labor. Okay, now in this question, and let's just read through this. And for these questions, I think it's helpful to know what they're asking you, if it's labor or what. But I really think, and you're going to have 3 hours to work your final, but I really think it's worthwhile to carefully read the question. Again, it has more to do with reading comprehension, and it's really easy to misread something in these. So just read the whole thing first, maybe go back and look at it again, etc. Right? Till you're really comfortable with what you're reading with these. So Milano Corporation is working on direct labor budget for the next 2 months. Okay, they want 2 months worth of information. Each unit of output requires 0.5 hours of direct labor. The direct labor rate is going down. It was 10, now it's down to 980 per direct labor hour. Obviously, I have a pet peeve about minimum wages. The production budget calls for producing 6,400 units in October and 6,300 units in November. Good. They want what? They're going to ask me for 2 months worth of information. So I'm going to have to pick up both months. If the direct labor workforce is fully adjusted to the total number if the direct labor workforce is fully adjusted, the total number of labor hours needed each month, what would be the total combined labor? In other words, that's a weird way of saying they don't have a minimum amount of guaranteed hours. So I'm just going to pick up the number of hours I need to produce the units. So I sit here and I say, okay, fine. If that's the case, then I'm going to pick up the what? 64, the 63. It's what? Half hour per unit. That means I need what? 3,200 hours for October, 3,150 for November, times the horrible wage of $9.80 per hour gives me what? Gives me my labor cost for each month. Of course, I have to add those together to get the right answer for the 2 months. See how important it is to read the question carefully, guys? If you didn't, they give you answers that contemplate only 1 month. Okay, C is clearly, different than the other choices. And if you didn't pick this up, you'd be wandering the earth trying to figure out what's going on with this question. That's why I tell you, read these carefully. Okay. Okay, good. Let's take a look at this next one. Okay, I'm gonna try to erase some of this. This is getting a little sloppy to see what's going on here. Okay, so let's take a look. Maury Corporation is working, again, direct labor budget for the next 2 months. Each unit of output requires 0.75 direct labor hours. The direct labor rate, man, we keep going down, is $8.10 per direct labor hour. The production budget calls for 2,000 units in March and 2,300 units in April. The company guarantees its direct labor workforce 40 hours per week with the number of currently employed, the number that is currently employed. That means the company is committed to paying its direct labor force at least 1,760 hours in the total month, even if there's not enough work to keep them busy. Well, for $8.10 an hour, you should let them take a break every 5 minutes. What would be the total combined direct labor costs for, and again, they asked me for the 2 months. Okay, so we've got April and March, and they need what? They need required production of 2,000 and 3,000. And when we take a look, notice both those numbers are what? Are under the guaranteed. So if that's the case, what do you have to do? You pick up the, I wanted to change the color, it didn't change for me. You pick up what? You pick up what? You pick up the guaranteed. Okay, because they were both under the guarantee. Now let me ask you a question. What would happen, okay, if, say, after they did the math, the math isn't going to match to what the question told me, but let's say after they did the math, it turned out they needed 2,000 hours. What would you do? Would you still multiply by 1,760?
No.
What would you do?
Multiply with 2,000.
Good. I'd pick up that 2,000. Very good. I pick up that 2,000 times the 810, right? Okay. But in this question, the needed hours were under the minimum, so we use the minimum. So you use what? The larger of the minimum, or what? Or the actual needed for production. Okay. And then, of course, you just added those two together to get the 2 month total. Okay, good. Let's take a look at this one. So we've dealt with what? We've dealt with material. We dealt with cash collections for our disbursements. We've dealt with materials. We've dealt with labor. Let's take a look at overhead. And this is how I'm going to test you on this. I'm not going to say do the whole thing and then tell me the total disbursements or anything like that. I will ask you for each item: collections, production budget, sales budget, collections, disbursements by category, materials, labor, and now we're gonna see overhead, okay? So let's take a look. The manufacturing overhead budget at Emerine Corporation, however they pronounce that, is based on budgeted direct labor hours. The direct labor budget indicates 4,900 direct labor hours will be required in August. The variable overhead rate is $490 per direct labor hour. The company's budgeted fixed manufacturing overhead is $96.40 per month, which includes $7,350 of depreciation. Now you see why I was going nuts when I was thinking you don't understand depreciation, because you'd have to know by reading that the depreciation does not use cash. That's how I'm going to ask you. I'm not going to say, and there's a non-cash cost called depreciation. I'll call out depreciation, and you are to know that that does not use cash. Okay, all other fixed manufacturing overhead represent, okay, current cash flows, so they kind of tipped you off there. The August cash disbursement for manufacturing overhead will be 4,900 budgeted direct labor hours. Variable per hour is $940. There's my variable cash plus my total overhead. That gives me now 142,100, but I got to back out the depreciation because depreciation does not use cash. Question? Okay, I'm not going to ask you anything dealing with calculating predetermined overhead rate. That was chapter 3.2.3. I don't know why I picked that question up. So ignore that. Okay, we're past that stuff. Okay, good. Let's take a look now. We did now our product cost. Let's look at our period cost, our selling and administrative. Okay. And what happens? We're budgeting 4,800 units for February. The variable selling and administrative expense is $810 per unit. The budgeted fixed selling and administrative expenses of $71,250, which includes depreciation of $16,800 per month. The remainder of the fixed selling and administrative expenses represent cash flows. In other words, depreciation does not use cash. The cash disbursements for the selling and administrative expenses for February, the number of units we plan to sell, the variable cost per unit, plus the fixed cost, minus the amount for depreciation, because depreciation does not use cash. Okay. Okay, good. So now we have our receipts, we have our disbursements. So let's go ahead and see what our cash needs are going to be, right? So that's how we're going to do it. I'll ask you questions about receipts. I'll ask you questions about production. I'll ask you questions about receipts on the sales. I'll ask you about what's needed to produce that in materials cash. What's the materials cash budget? What's the labor cash budget? What's the overhead cash budget? What's the selling and administrative cash budget? And then I'll just tell you in a question like this what the total receipts are and what the total disbursements are. And you need to figure out whether they need to borrow cash or what the ending cash balance will be, etc. Okay, so what happens? They tell me here, Lori Inc. is working on its cash budget for May, and we have beginning balance cash of 45,000. I know I'm going to pick that number up because that's what they're starting the period with. Budgeted cash receipts are 129. Okay, put that with the cash I already had. So I'll have total available cash of 174. They tell me that the disbursement is 124. So I am going to have excess cash left over of what? 50,000. Now the question could stop there. But in this particular one, they said, well, the desired ending cash balance is 60. So how much do I need to borrow? Well, if the remaining needs to be 60 and I have only 50, then I got to borrow what? I got to borrow 10 to bring me up to 60. Reading comprehension, guys. Notice there is no question about debit, no question about credit here. I'm not asking you to turn these into a full-blown set of budgeted financial statements. I just want you to be able to read the facts of the problem and apply the tools that we've learned here in this chapter to be able to answer these questions. Okay. Okay. Any questions? All right, I'll tell you what I'm going to do. I'm going to let you look at the rest of these. There's only a couple more. Okay, and we will reconvene on next Wednesday, whatever day that is, next Wednesday. I'll see if there's any questions about these remaining ones. Chapter 9, 10. Okay, come prepared to participate, guys. I think you could tell that I'm a little disappointed that we've gone into, radio silent mode here when I made a deal with you at the beginning that I would sit here and work through all this stuff with you and keep the midterms and stuff consistent with what we've studied, and we're doing well on these midterms, but I expect you to come to class. I expect you to participate, okay? All right, guys, I will see you. If there's no questions, any questions? Be looking at that guest speaker write-up. Don't wait till the last minute on that. I'm giving you a little extra time here at the end of these classes to give you the opportunity to work on that too. So take advantage of what's the way things are lining up for you. There's no reason for you to say you don't have time to put together this guest speaker write-up and do a good job with it. Okay, guys, I will see you next week. All right, have a good rest of the evening.
Thank you so much.
Thanks, Professor.
Thank you.
Bye, guys.
Professor, can I ask you a question?
Yeah, let me stop the recording, okay? Because if it's something dealing with your grade or something, I don't want that recorded. So I'm going to stop the recording.